Ladies and gentlemen, please welcome our first panel, Navigating Rough Waters, Global Challenges and Trends. Moderated by Gillian Tett, U.S. Managing Editor, Financial Times. She's joined by speakers Greg Ip, Chief Economics Commentator, The Wall Street Journal, Brian Moynihan, Chairman of the Board and CEO, Bank of America, and V. Shankar, CEO and Partner, Gateway Partners. Ready, camera two.
Well, good morning, everybody.
Came in from Charlotte or down the street?
Good morning, everybody. Third time in trying. Good morning, everybody. And and the fact it's hard to shut you lot up shows what a lot there is to talk about and what a great time it is to be having an event like this. Even at the best of times, Fred Hochberg is a tough act to follow on stage. And this first panel, I won't be filled with quite so much emotion, but I hope it has plenty of provocative ideas and controversy. Because the panel is entitled Navigating Rough Waters, Global Challenges and Trends. And right now, the waters of the global economy are not just rough, but potentially quite perplexing. I sometimes tell my colleagues that we live in Alice in Wonderland economic times, because we live at a time when we thought globalization was going in one direction. It now seems to be going in reverse in some areas. We thought that interest rates would always be positive. Now, in many parts of the world, they're anything but. And many of the assumptions we've made about the global economy are starting to falter. But we also live in Alice in Wonderland political times. We live at a time of Donald Trump. We live at a time of Bernie Sanders, that to my mind is actually emerging as one of the more interesting populist threats. We live at a time of Jeremy Corbyn, a time when the Spanish government barely has a government. We live at a time when politics in many parts of the world is also behaving very unexpectedly. So what does that mean for you as exporters, financiers, bankers, or anybody else who actually has to make a living in this Alice in Wonderland world? We have a fantastic panel to discuss this. At my far right, your left, is Greg Ip, a man who is an economic luminary, doyen of the economics commentary world, working for the Wall Street Journal, the Financial Times' rival, but I won't hold that against him. Next to him is Brian Moynihan, CEO of Bank of America, which is, of course, sitting at the very core of the American financial system and economy, not to mention the global trading flows too. And my immediate right, your left, is V. Shankar, who's Chief Executive Officer and Partner of Gateway Partners, an emerging markets private equity firm, but he was previously at Standard Chartered in another luminary there as well. So we have a combination of developed emerging markets, world's expertise, and Greg Ip, who I'm counting on to say provocative things that the other two can't and keep their jobs. So I'd like to start with you, Brian. And I do hope you will be provocative. I think your job is secure.
That's a great introduction.
When you look,
keep my job so far.
when you look at the global economy today, when you look at America, are you feeling concerned about the way things are going? I mean, we have a story on the front page of the Financial Times today, which I hope you're all clutching, which says, minutes show Fed policymakers at loggerheads over next rise in rates, and in particular, they're warning of, quotes, appreciable risks to the US economy from global turbulence. Are you worried about appreciable risks hurting the US economy and the wider global economic situation?
Well, I think the way that I think about it is there's a tug of war between the huge consumer-driven economy in the United States, which continues to push forward. And to give you an example, our customers in the first 3 months of the year spent well over 4% more than they spent last year on their debit and credit cards, and that's even with a 1% downdraft implied by gasoline prices. So the consumers are spending, deposits are up, borrowing continues to grow. So you're seeing this U.S. consumer-led economy, which is just this consumer piece of it is bigger than most economies in the world, that is in a bit of a tug of war, and with the emerging market economies and sort of, can this economy in the U.S. keep hanging on long enough for those economies to catch back up? And then you have Europe, which is sort of in the middle, which has a fairly sizable consumer-led economy when you put it all together, which also is doing better. And the question is, will that hang on because it's a little more exposed to exports and things in the United States? And so that tug-of-war is, I think, what you reflect in the Fed minutes is as they look at the U.S. economy, unemployment is at the targets, inflation's moving up, wage growth is starting to go through there. Today, new claims again down. Millions of people back in the workforce, 200,000 jobs. All that implies that we should be normalizing, yet because of the globalization you talked about, they have to be very sensitive, not only for two purposes. One, the impact of the outside the world could have dragged the United States back, and then secondly, the impact of the outside, what the United States does on the outside world, raising rates and the impact it have. And I think they're just trying to make that judgment and err on the side of being cautious. You read the minutes, that's the debate. By the way, it's the same debate they've had for the last several meetings, and I think they're very clear about it, and I think they've been very transparent about it. But the reality is, even if they start moving rates, which they did in December, it'll be very low and slow to ensure that this economy keeps chugging forward. Well, that tug-of-war, and hopefully the United States doesn't win because it's the United States, hopefully it wins because the rest of the world then can catch back up. So
just to seize on that number again, so you said that consumer spending on credit cards was up 12%?
4%.
4%.
4.5%.
4.5%. I thought that sounded too good to be true. So 4.5% growth in consumer spending on credit cards. Which,
credit and debit, both.
And debit, which of course is really pretty remarkable, pretty striking.
The fastest growth rate in 15 was the fourth quarter, and this is faster than that growth rate year over year comparative quarter. And so but it's people are plugging on, they're spending money. And by the way, deposits are growing too. So it's an interesting conundrum because you hear all the stuff out there, but more people employed and more people are spending.
Right. So once again, the American consumer is back with its shopping bags, powering the global economy, or maybe not. What do you think needs to be done to make you feel more optimistic about the growth outlook? I mean, when you look ahead, what would you like to see to make you feel that, if not in America, the rest of the world is actually matching those American consumers with their shopping bags?
Well, there's long-term structural change that's going on in these countries, but I think the key in the G20 reflected on this recently is you have to, the monetary policy elements have been deployed, have been out there a long time, and so now you're into the question of fiscal policy, and I think the statements out of the G20 in terms of austerity versus spending, now weighted entirely towards helping stimulate, which I think is a good thing. So I think those countries need to get back in spending. They got to have a little bit of room on the debt side and things like that. But of course, the real key is to have both India and China, and Mr. Modi and what they've been able to do in India, have that continue forward, and also have China stabilize. And you're seeing signs of China stabilizing, both of which is a confidence element and also a practical. It's a lot of people, a lot of economy. So I think the key is that fiscal side is starting to be recognized that they have to move. The big wild card in all that is what you said. You have a series of elections and going on that you laid out that are, and maybe you can study it, but it's a series of things that you have to think through. You got Brexit, you got votes coming up in countries, you got Spain that hasn't quite seated a government yet. You've got these right-left splits going on around the world, and those things just keep coming at you, and that affects this question of what policy will be. And
right.
When I look around the world, to me it's all about who's going to be making the decisions, and will they make the decisions consistent with the way the experts think they should, and that comes down to political elections.
Well, it's a polite way of saying that actually right now economists aren't much use if you want a crystal ball. You really ought to be hiring political scientists, or dare I say it, anthropologists. Speaking as someone who trains in anthropology. But as Brian says, it's all eyes right now on India and China. And Shankar, you are building a private equity fund, having just come from Standard Chartered Bank, which is in many ways the main emerging markets bank or global emerging markets bank. You've come from the banking world and you're now trying to build a private equity fund that can spot growth opportunities in countries like India and China and Africa. Are you optimistic about the outlook right now for China and India? Because, a lot of the discussion in the policy-making stage arena is about whether China's going to have a big crisis or not.
The short answer is yes, I am optimistic in the medium to long run. In the short run, you should expect a lot of volatility, and a lot of gyrations. But it's not just China and India. It's emerging markets broadly defined. So that's Africa, it's LATAM, it's Middle East, it's Asia. And why am I optimistic? Really 4 reasons. 1, demographics. If you look at the population, 2/3 of the population under the age of 35. So that can lead to a huge demographic dividend if handled well. On the other hand, it could lead to a tremendous demographic debacle if not handled well, admittedly. The second reason I'm optimistic is urbanization. If you just take that emerging market footprint, roughly about 2 billion people will get urbanized over the next 30 years. And roughly 3/4 of that just from India, Indonesia, and sub-Saharan Africa. So demographics, urbanization equals consumption. And the third factor, therefore, is actually a growth in manufacturing and services to meet the demands of those consumers. And that's going to be across the board. The fourth reason why I'm optimistic is that despite the slowdown in trade, and I know you carried something on that not that long ago in the Financial Times, the biggest economic growth engine it has been over the last 20 years, the South-South trade and investment flows. South-South trade has grown twice as fast as global trade. And I still see that engine motoring. If you take many of the emerging markets today, almost half of the foreign direct investment today comes from other emerging markets. So demographics, urbanization, growth in manufacturing, services, consumption, and South-South trade and investment flows, long-term, I'm tremendously positive.
So if you had to pick just 1 or 2 countries that makes you feel most excited right now, what would you point to? Or would you like to mention some countries you wouldn't touch with a barge pole?
Being politically correct, I'll go for the former.
I'm counting on Greg to go for the latter.
Yeah, Greg, that's up to Greg. Because I still need to do business in a lot of countries. So, an excitement. I'm clearly, as Brian mentioned, India has got the momentum under Prime Minister Modi. The question is, a large ship like India, can it be moved, tilted quick enough, fast enough? And will it keel over or will it actually charge ahead? So he's got a tremendous challenge, but I'm positive in India. And this is not a country. I'm not showing any ignorance of geography, but sub-Saharan Africa. I mean, if you just look at the tremendous opportunities there in terms of the consumer economy, the infrastructure needs of Africa, the resources and the agriculture, and if you think about food security and what it means, the role that Africa needs to play with 60% of the world's uncultivated arable land being in Africa, I'm excited about Africa.
Right. Well, Greg, you don't have to be politically correct. So tell us what you really think about the global economy.
So I think that I actually, feel better than a lot of folks out there. I mean, I was really struck by the gloom coming out of the Shanghai summit 2 months ago, the need to elevate all sorts of policy tools. But actually, we've seen just in the last 4 to 6 weeks, I think, an inflection point, and largely it was driven by 2 things. Oil found a bottom, and the Federal Reserve essentially changed its message about how fixated it was on raising interest rates this year. And if you just look at 2 things, the price of oil and the dollar, both those things have moved in very constructive directions. And so never make predictions, especially about the future, but my prediction, which I hope I won't have to defend a year from now, is that the global economy more or less hit bottom in the first quarter. And when I hear what Brian says about consumer spending in the United States, it's very, very encouraging because it suggests that notwithstanding the terrible headlines and market volatility we went through in the last few months, it didn't really undermine that fundamental base of job and income growth that drives spending. Now, that's the good news. And the bad news is that for the last 6 or 7 years, I think, the narrative of the global economy is we went through this terrible recession. We're way, way below its normal capacity. And what the global economy really needs is more demand, whether it's more monetary stimulus or more fiscal stimulus. But I think with each passing year, that story has gotten a little bit more threadbare, notwithstanding the weakness in growth performance. And by the way, probably in about a week's time, the International Monetary Fund will lower its forecast for global growth for approximately the 6th time in 6 years. What's striking is that even as they lower this forecast, unemployment keeps coming down and job creation is amazing. I mean, 10 or 15 years ago, we would complain about jobless growth. Now we have growthless jobs. And I think the story here is one that has gotten far too little attention right now, which is that demand is a little bit constrained, but the real problem is supply. Potential growth rates around the world have plummeted in the last 6 or 7 years. And that's not just true in the United States or Britain. It's true even in countries like Brazil that did not have a global financial crisis. And there are two big drivers for this, and they're largely global. One is the world is getting older. With the exception of the country, Shankar, where you work, almost every country is getting older now. China's working age population has flattened out, is now declining. In the OECD, for the first time in the post-war period, in advanced countries, total working age population is declining. That is undermining the labor supply. Even worse, the productivity picture is looking pretty bad. So if you sort of ask your question, where do we go from here? I am less concerned about the potholes of like this crisis or that crisis. I'm more concerned that with each passing month, it looks like there is no fundamental long-term growth driver out there. And I don't think policymakers have a good answer for this.
Gosh. Well, I love the phrase growthless jobs. I think I fully intend to plagiarize that myself. But I guess one of the practical questions, which is of great interest to everyone in the room, is what does this all mean for trade? I mean, can the American consumer with their shopping bags power trading flows by themselves? Or are we actually going to see a continued slowdown in trade? Because as Shankar says, at the FT recently, we had a big feature on the fact that trade has actually been slowing down. This is really quite striking given the pattern we've seen in the last 2 or 3 decades, or other trade growth relative to GDP. And what's doubly striking was I was up at Yale yesterday at the business school there and looking at some of the figures on FDI flows. And again, what you see is a real slowdown in cross-border FDI when you look at a 2 to 3 decade trend. So is this just a short-term response to volatility? Is this a response to Donald Trump and protectionism, or not Donald Trump, but rather that whole protectionist movement? Or are we seeing something more fundamental about the nature of the global economy beginning to shift? Is it the case actually all the supply chain integration that occurred at such a feverish pace 20 years ago has happened, and we won't see that kind of trading increase continued? Who wants to? Brian?
I think what Greg said about the population demographic change, we do a lot of work and for a couple different reasons, but we do a lot of work around the changing demographic in the United States and around the world. And I think people forget that. The United States population, and a lot of times when people said trend growth was 3.5%, was growing at 1.5% or 2% a year, and now it's growing like 0.5%. Now part of that's immigration policy, and part of that's just aging and where people are. And then if you looked at Greg's paper today, which everybody should be clutching. I'll run the commercial for Greg. But if you look at one of the sections...
You can clutch the FT instead if you want.
We won't fight over whose you should read first, as long as you read them both.
I think in the section, the fourth section, whatever it's called, but there was the headline was women over 40 buy less stuff, right? And so what happens is you have this consumption change as people get older, because they're saving for retirement, they're repositioning themselves, the way they consume is different, downsizing. How you pick the thing, and that has an impact. And by the way, that's going on in every developed society, other than a few places, India and Africa and others. And we have one of our analysts, and I won't take credit for this, he has a ratio he calls the Demi-Ashton ratio, which is number of 40-year-olds on top of 20-year-olds. And that ratio he judges countries by on their ability to grow. And India is one of the countries. And he writes this, and it does it, and it always gets a little giggle. But the reality is that demographic change is a serious element that then affects these long-term growth rates and consumption rates that people just sort of gloss over and forget about.
Right.
Gillian, I would say, Brian talked about the American consumer spending. Let me just give one factoid on UAE, where I live, on credit card spending, since he brought credit card spending. I saw a statistic that credit card spending in UAE, which is a major, hugely dependent on travel and tourism, and therefore it's a good indicator, has grown only by about 1% this year, as opposed to, let's say,
slower than American.
Slower than American, and probably credit card spending was growing at about 8-10% in the past. But what is even more illuminating there is credit card spending by Chinese credit card users is down 18%, and
Wow.
Russians down roughly about 50%. So I think, and so the Chinese economy and what's happening in Chinese economy is having a magnified impact far beyond the borders of China. And you can see it in the results of some of the luxury goods chains, whoever it is, whether it's Burberry or others, Chinese consumers spending less. So let's not forget that the slowing China, I'm not in the camp of saying China is going to collapse, far from it, but the slowing China has got a magnified impact on the world. So let's just run the math of it. China is a 10 trillion GDP economy. A 4% or a 5% slowdown in the growth of China takes away 500 billion of GDP from the world. Or put it the other way, that slowdown in growth is effectively the same as India's GDP in 3.5, 4 years.
Wow.
Okay, so it's got a huge impact. And the slowdown on China and their repivoting away from investment-led economy to the consumption-led economy means that it's had a huge impact on commodity prices. So whether you take iron ore or anything else. So when we talk about the slowdown in trade, we need to be careful about a few things. How much of that slowdown is volumetric, and how much of it is because of price reduction, right? I mean, 1 barrel of oil exported 2 years ago was $100. Today it's $40. So your stats show it as $40. That's still 1 barrel of oil. The second thing we need to watch out is what you talked about, the global supply chain. That's a positive and a negative. Just think about it. In the old days, if we were producing all the stuff in one country and exporting it to another, and he exported it for $100, the trade stats said global trade was $100. Today, because of global supply chain, the way intermediate production is split up, that same thing could be it could be happening in 3 countries, and let's assume it's done $30, $30, and $40. You're actually showing in a good time $160 of exports or trade, but now it's $100. So a slowdown has got you've got to think through the stats a bit.
No, I couldn't agree more. I must say, I recently looked at the auto sector in America, and the statistics in terms of measuring what's happening in terms of trade are very confusing often. But Greg, how do you explain this slowdown in trade?
Shankar made a very good point, is that just the big decline in commodity prices that we've experienced, especially in oil, just arithmetically really reduces the value of cross-border flows. But even if you actually extract from the price effects and look at real trade volumes, and you look at the ratio of trade volumes to global GDP, that number has basically flatlined since 2008. We have made no progress in that great post-war story of rising globalization in this 7-year window. Now, this is actually the second time in the post-war period we've seen such a flattening. The other time was in the late 70s and early 1980s. So if you want to look at this ratio as a chart, it basically rises steadily in the 40s, 50s, and 60s, flattens out in the 70s and 80s, and then takes off again towards the late 80s and early 90s with globalization, the fall of the Berlin Wall, and then, of course, China entry into the World Trade Organization. Well, what can we learn from this? Well, what those two periods had in common was that they were both very weak periods for global growth, which raises the question, did weak global growth pull down trade, or did weak trade pull down global growth? And of course, as always things, I'm an economist, so it's a bit of one hand on the other hand, and there's an endogeneity there. They're both going on. So the point that you made, Shankar, that of course that there's less outsourcing to China and there's less that pulls down commodity volumes, that's clearly having an effect. But it's also the case that one of the as we outsource less, and as supply chains kind of reach their logical maximum in terms of creating efficiency, there's simply less compulsion to do more. And I'm not going to make the mistake of making a big grand prediction of where either productivity or supply chains or global growth over the next 10 years goes. But there is another important parallel of the 70s and 80s, which is as you got to the end of that period of weak growth and weak trade, protectionism also became much more pronounced. You saw a big slowing in trade liberalization. That was a period when Ronald Reagan, who was a free trader, came into office and still felt compelled to impose things like voluntary export restraints and things like semiconductor quotas on Japan. And today we're sort of like playing that movie once again. What's fascinating to me about Donald Trump is that it took 7 or 8 years for him to show up and to actually make political hay out of a trend that's been underway for some time. Many of the things that he's complaining about actually stopped getting worse 7 or 8 years ago, as we were talking about outsourcing as more or less died off, and illegal immigration, actually the stock of illegal immigrants in the United States has actually been going down for the last 7 or 8 years. Needless to say, nonetheless, though, he is obviously, and Bernie Sanders, are milking the unhappiness among a lot of middle-class, blue-collar workers about the lack of real growth and real incomes, and that manifests itself as a backlash against globalization. And so I think for the folks in this room, I think one of the big question marks is the extent to which that finds its way into the actual policies the next president implements. And that can, after a period when trade is already battling these structural headwinds in terms of weaker commodity flows and less outsourcing, it will then have a third headwind of a less friendly policy environment, making it harder or at least less likely to enjoy further liberalization of cross-border transactions.
Well, I couldn't agree more. And let's talk about that politics for a moment. Because I was on a panel like this on Monday night in New York with one of the veritable luminaries of the American financial world. Not Brian Moynihan, but somebody else, and you can all try and guess who made 3 predictions. Firstly, he now thinks, and it is a he, there aren't many she's around anyway, but he now thinks that there's a 55% chance of Brexit. He now thinks that there's a 20% chance of a Chinese financial crisis or serious round of turmoil, and that there's this was before Wisconsin, a 50% plus chance of Trump as a nominee and a non-negligible chance that he could be president. So I'm curious, I'd like to ask you each first, starting with Brian. Would you agree with a 55% chance of Brexit today and a 20% chance of Chinese financial turmoil? And then I'll come on to Trump.
On the Brexit, what I'm told by some colleagues I was with this week who are close to it in the country, the bookies actually have it the other way around still, and they tended to be right. So I think the people of England, UK will vote, and I think we've been clear that we don't think it's a good thing, but the reality is they're going to vote on it, and I think that has an unpredictability that is on people's minds, obviously, and on the market's minds, and we're preparing for either way, like we do as a good financial services. But I think everybody tells me follow the bookies; they tend to be right on these things, and they're still on the side of in, so to speak. So I'd say that. What was the second one? The second one was China.
Second was China. Yes.
Our core view of China is its growth rate has slowed, but is in 6.5, and our analysts that spend a lot of time on that. They don't see that there's that kind of elements, and people forget that it's an integrated economy in terms of, the big banks are owned 60-70% by the government. They'll clean them up. They did before. We invested in one of those banks after the government cleaned it up before. China Construction Bank, a wonderful company. I think those institutions, some of them, they're making $30 billion after tax. I mean, they have a lot of absorption power, and they have 10% common equity, so they can be cleaned up a little easier than somebody struggling. So I think people forget that there's integrated, that they can manage this a little bit differently, although there's serious problems with shadow banking and all the stuff. But our experts think that it slows, as Shekhar said, but not a crash type of thing. So I think.
So what about Trump?
I'd follow the bookies because who has better information, and I think our experts would believe China's okay.
And what about Trump?
American politics I can't explain, so.
You wouldn't like to give any prediction about the election?
I only have 50 million customers, and I follow what they tell me. They'll vote someday, and then I'll figure out who they elected, and we'll get on with it. So.
Okay, well, Greg.
Let's go through, what were those probabilities again? 55% on Brexit.
Yes.
20% of Chinese financial crisis. And what was the Trump?
Just over 50%, well, Trump as nominee, and which is still a very bold bet, and potentially a non-negligible chance of Trump as president. So curious about how you see the chance of populism rising in America. You can take them in whatever order you like.
Well, populism has already risen in America, so that chance is approximately 100%. Thank you. That was a real softball there, Julian. I kind of wish I was like Brian and I could claim that I'm not supposed to talk about American politics, but unfortunately I don't have that excuse because I can make a prediction about Trump, but you should remember that, first of all, I don't do politics for a living, and second, the people who do politics for a living have been systematically wrong every turn of the way on this thing. So, first of all, if Trump, I think there is a good chance that Trump is a nominee, but I think the odds are very small that he will be the president because his negatives are so high, because he is very weak across key demographic groups and likely in this election, that and if Hillary Clinton is the nominee, she has very high negatives, and there's a lot of things people don't like about her, but she's largely a known quantity. She's been around for a long time. People who are inclined not to like Hillary already don't like her and know why they don't like her. But with Donald Trump, it's still, I think, a familiarization process, and every few weeks more people become more familiar with him, and if you trust the polls, as they become more familiar, his negatives rise. But I think I'm going to play a little game here, Jillian, which is first of all, let's say that the odds that Trump is the president are 40%, okay? Which means that the odds that he's not president are 60%. And let's say the odds of Brexit are 50%. So and the odds of a Chinese crisis are 20%. Well, if you multiply the odds of none of those things happening, that's 80% times 40%, which is 32%, times 50%, that's 16%. Thank you. That's why you run a bank and I don't. Well, that means that the probability of none of those things happening is only 16%. Now, I make the heroic assumption that there's no correlation between those three things. But I make that point out, which is that there's approximately 80% chance that something really unexpected and disruptive on the political front will happen this year. And I think that's what policymakers, investors, and businesses have to keep in mind. And it would be one thing if you knew what Brexit meant, or what a Trump presidency meant, or a Chinese financial crisis meant. But I think what is especially intimidating about these possibilities is that we don't actually know what any of those things mean. We are sort of like, just to look at the U.S. Presidential election for a moment, is that, Jillian, you and I have watched a lot of presidential campaigns over the years, and they certainly are wild and woolly affairs, and a lot of crazy things get said. But they have tended to operate within guardrails that we could say are within one standard deviation of the norm of what policies the president of a major party is going to promote. We are now seeing in Donald Trump and Bernie Sanders very large levels of support for policy positions that are way outside that one standard deviation limit. And first of all, we don't know specifically, certainly in the case of Trump, what the actual policies will be. We also don't know what the ability of that president is to enact those policies, given that they will be dealing with various constraints on them. The larger story is that I think we're dealing with a degree of uncertainty on the political front that is probably the highest I can remember in a very long time.
Yes. No. I mean, it's great for bookies, businesses. It's great for financial journalists or journalists of any stripe. It's probably very good for any traders who are trading on the back of financial market volatility. It's pretty scary for corporates who actually have to make a business from selling things. So I'm curious, I mean, Shankar, when you look at America today, what do you make of American politics? Does Trump scare you?
You know, I didn't hear this 50% prediction, but the other 50% I heard was that Mr. Trump's running mate was going to be Kim Kardashian.
And does that scare you more
anyway,
or less?
No, for most people outside looking at not just American politics, but politics everywhere in the world, it's become a very divided and disconnected world. And whether it's not just Mr. Trump, but a lot of, and you can see that happening everywhere, people are tapping into a deep vein of anger among the population. And I was talking about this to a former leader of a Western country. And previously, you won elections by bringing people to the middle. And today, when you look at the world everywhere, the left is becoming more left, the right is becoming more right, and sometimes you just wonder whether there's a center. So if you're a politician, it's going to become far more difficult in terms of calibrating, where do you position yourself? And your question on Brexit, we had the same, vacillation in terms of, probabilities relating to the Scottish referendum. It was too close to call. Again, the Brexit discussion is about anger, about, jobs and the top 1% getting too much of the gains of the economic wealth creation process. So I think we're just tapping into it. On China, I'm completely in Brian's camp. China is here for good. And let's not forget, China is not dependent on external funding and capital to recapitalize its financial system. And if you go back to the 1997 financial crisis in Asia, whether it was Korea or Thailand or Malaysia or other places, the ones who got into trouble were those who were hugely dependent on foreign capital and foreign borrowings. China has got over $3 trillion of reserves to weather the storm.
So what does this mean in tangible policy-making terms? I mean, to pick up on Greg's question, because, let's discount the possibility that we end up with a giant wall between Mexico and America, which would be good for the construction trade, but probably not much else. What are the aspects, Greg, to throw the question back at you, on the policy-making debate that concern you? Practical policies, because we've not seen a lot of it yet from Trump or anybody else, but what are the key words or phrases that people in the audience should be looking at, either in America or elsewhere?
I think it's almost easier to talk about what we cannot expect, simply because what's interesting about a lot of the populist movements we've seen around the world, including here and in Europe, is that they're being generated by a very strong feeling about what we don't want and who we don't want to be in charge. So the people who are fueling the Bernie Sanders and the Trump campaigns better understand who they're not, what they're against, as opposed to what they're for. They're against more globalization. They're against more immigration. A lot of them are against banks. Nothing personal, Brian. And in Europe, in Britain, they're against more immigration. In continental Europe, the same thing. What is troubling now? First of all, there's nothing new about a lot of this populism. By the way. Thomas Jefferson said a lot of nasty things about banks in his day. The Eurosceptic...
That was really geared at Alexander Hamilton, you got to remember that.
Yeah, and Alexander Hamilton got the last laugh, or the musical in any case.
I'm not sure he got the last laugh, he got the last bullet.
He went out on a high note.
Yeah, exactly.
But Euroscepticism is not a new phenomenon, nor is Scottish nationalism in the British context. What is new, I think, is that these movements have found a voice in establishment parties, or in parties that are about to break into the establishment ranks. David Cameron has had to essentially, to a greater extent than perhaps even he anticipated, had to incorporate the views of the Eurosceptic caucus in his party. We had Ross Perot run as a populist third-party candidate twice in the 1990s. That candidate is now Donald Trump, and he could become the leader of one of the major political parties. So, and one of the things that's driven these things, I think, is that voters themselves, is that the establishment, if you will, doesn't have a good counter-argument about why the voters should stick with the conventional mainstream policies that they have run with for the last 10 or 20 years. I mean, here in the United States, the average American voter has had 8 years of a Republican presidency and 8 years of an Obama presidency, and the median household income is still roughly in real terms where it was in the early 1980s. And they might be sort of taking the attitude, well, we have nothing to lose. So for the people in this audience, and by the way, I did my numbers a little bit wrong. I think it's more like there's a 25% chance that none of those bad things will happen. So for the people in this audience, I think some of the things that you hope would be really good, like a business-friendly tax reform or a ratification of the Trans-Pacific Partnership, become much less likely because the traditional parties that were advocates of those positions are significantly weakened. And even if, just look at Hillary Clinton, who ran to the left of Barack Obama in 2008 and now has Bernie Sanders running to the left of her, is going to be invariably pushed further in that direction. And even if she would like to do some of the things that the business community would like to do, it's a question mark whether she will have the political capital to do so if she's the president next year.
Well, if you think Bernie Sanders is left-wing, you haven't seen Jeremy Corbyn yet in the UK. Politics indeed is becoming very broadly spread.
This is where you get to the fundamental difference between a two-party system and a parliamentary system. At the end of the day, and what's happened in the United States with the dynamics of some of the, as Greg said, some of the pieces of these parties have gotten big enough, they've actually created more of a parliamentary system that you're trying to actually get a coalition. In a way, even though there's two parties, there's major fractions in each one of them. And so that's created this interesting dynamic. But the reality, when you go back to real policy decisions, is if you go back and look at, for example, what President Reagan ran on, I think he was going to get rid of 4 cabinet positions at the time, 4 departments were going to be gotten rid of, and all this, Department of Education, not to happen. Because the methodology of the U.S. requires Congress and requires a lot of people to agree. And so the real question is when you have alignment between both houses of Congress and the presidency is when you see massive policy changes. That's the thing, if you really want to watch for massive policy, that you have to watch out for, because then something can happen. Absent that, as Shakar said, the middling effect, and not in a negative way, but a driving towards the mass of the middle happens because you basically have no ability to get anything done unless somebody agrees. And it's been a little bit of a science lately not to get stuff done. But even in the last year, you're starting to see that thaw a little bit with the budget getting taken care of because people realize that was not a good thing. So I think, remember, whatever a person says to go in the election cycle, the dynamics of having two parties in different configurations, House, Senate, and White House, means there's a middle-of-the-road effect that goes on. The interesting thing is, could they ever align again? And remember that was 08 to 010, and it quickly changed. And that was
just to get practical and talk about something that it is your job to talk about. What probability would you give to the chance of you, as Bank of America, facing calls within the next 5 years to break up the banks?
Oh, we've been facing it for the last 8 years.
Or actually facing actual action to break up the banks?
I really don't think it's the right thing for customers and clients in America and in the world. The fact of the matter is, if you look out in this room and what this institution represents is trade and flows and global nature. And if you think about the supply chain that Greg referenced earlier, mid-sized companies, $300 million companies in the U.S., $400 million companies in the U.S. have global connectivity, and they need people to help them do it. So the reason why we're in these interesting places, the reason why we do it, is because our clients demand us to, both investors and corporate clients, and they do it because the world is the world. And so we have some clients that supplied into McDonald's, and I was at dinner with a couple of them, and they never would have thought 20 years ago they were going to have factories in Poland and places like that to supply the McDonald's chain. These are not huge companies. They're not, and so globalization's had this impact that you need banks that can actually serve companies around the world. From a public policy standpoint, the stability of the institutions, when they're combined the way they are, is actually much more stable than the Lehmans and Bear Stearns and Countrywides and all these people out on their own, quite frankly. We have $220 billion of equity. That's more equity than all those companies had combined by a lot. And yet we're a lot smaller than implied aspects of those things. So I think even Merrill on its own was very unstable. So I think the stability and the customers drive it. And I think it'll take a long time for people to sort of agree with that. But the reality is, we only do this because our customers demand us to do it.
Right.
If the customers didn't want it, we would get out of it.
Okay, so you don't want to break yourself up because guess what? Turkeys don't vote for Christmas. But if you had to put a betting probability on it, are you actually facing pressure or actually facing demands to break yourself up? What is it? 5%? 10%? 50%? 0%?
I'll tell you what our shareholders said last year. We had a resolution to form a committee look at this, and it got 4% of the vote. It's not. There are business model questions, and can you make fixed income profit? All that stuff people talk about. But the core business that we have is driven by the front to back nature of the simple question of a client that supports a real economy and generates massive amounts of jobs and growth in this country, or in another country, needs to raise money. They need banks that can take them to the markets and get it done. And then if they want to move money, they need banks. And by the way, from a policy standpoint, would you rather have banks which can actually get this right over time, doing it as opposed to a bunch of relying on it? If you think about the biggest issue in the rest of the world is they do not have a capital markets like the United States.
Right.
We have a duty and an obligation as large financial institutions to develop that in Europe and other places. Everybody looks at it and says, we wish we had a capital markets like yourselves, but it takes large institutions to do it because it takes tremendous investment. $900 million in systems we spend in markets a year in banking. Think about that, $900 million. It takes more revenue than that to be able to afford it. So those things, I think people think. So when people look around the world, when I go and talk to governments and policymakers, we would love to have United States capital markets. Well, to do that, you have to have pan
Right.
country companies that help you form it, and you have to have big pools of capital. You have to have big investors. That's the piece that has to get done, or else Brazil can't get to where it has to go to, Europe can't get to where it has to go to, China can't get where it has to go to, India can't get where it has to go to, Africa can't get where it has to go to. That's the role of the large financial institutions, and that's what we're here to do.
Right. Well, Shankar, I'm not going to ask you about banks, but you are in the private equity business, straddling borders. What worries you about the policy climate? I'm curious, for example, we're seeing, as part of the populist move, increasing focus on offshore tax havens, on taxation issues. Are you concerned that you don't face calls to break yourself up, but are you going to face calls to stop using offshore tax havens, things like that, as part of this populist movement?
I think it's happening. It will happen. You should expect it. In any event, you're not in this business to manage taxes. You're in this business to make profits for your investors and shareholders. And what I would just add to what Brian said is, and this is where the conundrum I see, the whole world, we are talking about globalization of trade, commerce, and investment, and how globalization of trade and investment flows is good for the world. Yet, when it comes to the banking industry, we increasingly talk about balkanizing it and making them just national. I just find a huge contradiction in this debate.
Yes, but that's politics.
Absolutely. So I think it's more important to understand politics than economics.
Well, as a former anthropologist, I agree, but that's my that's my personal job creation scheme.
Right.
But Greg.
I think one thing we need to keep in mind is that, again, the populist impulse is not new. It's been around for a number of years, a lot of this. And that populist impulse has manifested itself in some of the legislation we now have in place. Dodd-Frank does provide a lot of tools, and the regulatory climate has been very tough on banks for the last 7 or 8 years. Similarly, the Trans-Pacific Partnership, forced a lot of concessions on things like human rights and labor and so forth from other signatories. My point here is that before the next president decides to go that extra step and tear up trade agreements or break up the big banks, they're going to look at the landscape and decide whether most of what they want can already be done within the existing framework. Other than Bernie Sanders, I haven't seen a presidential candidate making a big deal about wanting to break up the big banks. The fact of the matter is there's a lot of tools at their disposal right now, and these policies and agreements develop a lot of institutional inertia, and tearing them up turns out to break a lot of China. And not many politicians, especially new ones, have an appetite for picking a lot of fights with a lot of people. So I think the odds today are still greater that we get gradual as opposed to convulsive change on either front.
Well, I think that's Greg's way of telling Brian and Shankar they don't need to worry too much yet. But it's been a fascinating discussion. Thank you all very much indeed. I guess I have, 3 key takeaways. Firstly, that the global economy is something of a mixed bag right now. Glass half full is that American consumers are still spending 4% up on credit card usage. It's striking. Glass half empty is that the emerging markets are troubled, and I think it was minus 18% and minus 15% for Chinese and I think Russian consumers is a sign of some of the weak spots. Second point is politics is not just unnerving, but profoundly unknowable. And I think we're dealing with an age when people who run companies, who are trained as economists, who have MBAs, are used to putting the future into nice little spreadsheets and algorithms and charts and trying to come out with numbers in terms of where the future's going. Right now, what's happening in the political sphere is profoundly difficult to model, predict, or to even forecast in any way whatsoever. So that's worrying. And my third conclusion is that even if it's bad for business, as I said earlier, it's fantastically good for pundits like Greg and myself. So we are entirely confident that we're going to have plenty more to write about over the next year. And good luck to all of you in figuring it out. So thank you very much indeed.
Okay. Great talk. Great job, Eileen.